The title of this video is Two Paths for the American Economy, and I want to talk about that. There's so much contrasting news these days about whether we're in a bubble or on the cusp of a new period of prosperity ushered in by AI. Our Chief Investment Officer, Larry Swedroe, recently wrote a piece on the subject, and I want to share our perspectives on this along with the investment implications. Over the next decade, the American economy could follow one of two dramatically different trajectories, each with profound implications for growth, inflation, and the nation's fiscal health. I want to talk about both an optimistic and a pessimistic scenario, and what, as an investor, you should know and act upon. First, let's talk about the optimistic path, an AI-driven prosperity. The first scenario envisions an economy transformed by artificial intelligence. In this future, AI doesn't just automate existing tasks. It fundamentally reimagines how we work, create, and solve problems, and with it, brings about a productivity renaissance. The key to this optimistic scenario is a dramatic acceleration in productivity growth. For decades, productivity gains in developed countries have been modest, averaging around 1 to 2% annually. But AI has the potential to alter this trend. From software development to scientific research, from healthcare diagnostics to supply chain optimization, AI tools are already demonstrating the ability to amplify human capabilities. When productivity rises rapidly, the economic pie grows faster. Companies can produce more with the same inputs. Wages can rise without triggering inflation, and tax revenues increase even without raising rates. This virtuous cycle creates the economic breathing room needed to manage fiscal challenges, and so the debt becomes manageable. Consider here a very simplified example, using some simple math. If GDP grows at 4% annually, combining real growth and moderate inflation, while debt grows at 3%, the debt to GDP ratio improves slowly over time. Add to that higher tax revenues from increased economic activity, and the fiscal picture brightens considerably. Moreover, AI-driven deflation in certain sectors could ease inflationary pressures. Just as the internet reduced information costs, AI could dramatically lower the cost of services from legal advice to education, helping to keep overall inflation in check. The AI revolution also promises spillover effects. As companies deploy AI tools, they discover new applications and business models. Entrepreneurs build on AI platforms to create entirely new industries. Scientific breakthroughs accelerate as AI helps researchers process vast data sets and identify patterns humans might miss. This innovation cycle becomes self-reinforcing. Higher productivity leads to more investment, which funds more research, which drives further productivity gains. In this scenario, America's tech leadership and deep capital markets position it to capture a disproportionate share of AI's economic benefits. That's the optimistic view. So now let's take a look at the pessimistic path, where mounting deficits trigger a vicious cycle of economic decline. The United States is running substantial budget deficits, even during periods of economic growth. As the government borrows heavily to finance these deficits, it competes with private businesses for available capital. This competition drives up interest rates, making it more expensive for companies to borrow for productive investments. The result is that government borrowing literally crowds private investment out of the market. Instead of funding investments, capital flows into treasury bonds, slowing productivity growth and constraining the economy's long-term potential. If investors begin to doubt America's fiscal sustainability, they'll demand higher yields to hold U.S. debt. These higher rates make the problem worse, requiring even more borrowing just to service existing obligations. This scenario could trigger a confidence crisis. As deficits mount and the debt-to-GDP ratio climbs higher, international investors may start to diversify away from dollar-denominated assets. The dollar's decline would make imports more expensive, importing inflation into the U.S. economy. Rising inflation creates a particularly thorny problem. The Federal Reserve would face pressure to raise interest rates to combat inflation, but higher rates increase the government's debt service cost, worsening the fiscal situation. Meanwhile, inflation erodes real wages and living standards. Workers demand higher nominal wages to keep pace, potentially triggering a wage price spiral. Businesses facing higher input costs and borrowing rates pull back on investment. Economic growth slows even as prices rise, reminiscent of the dreaded stagflation of the 1970s. Unlike the virtuous cycle of the optimistic scenario, this path creates a vicious cycle. Slow growth means lower tax revenues, forcing more borrowing. Higher borrowing drives rates up further, slowing growth some more. The dollar's decline makes imports expensive, fueling inflation, which necessitates higher rates, which slows growth further. In this scenario, the United States could find itself in a fiscal trap where an increasing share of federal spending goes merely to servicing debt rather than funding productive investments in infrastructure, education, or research, the very investments needed to boost growth. The stakes couldn't be higher. These aren't abstract academic scenarios. They represent fundamentally different futures for American prosperity. In the optimistic path, rising living standards, manageable debts, and American technological leadership create broadly shared prosperity. In the pessimistic path, fiscal crisis, inflation, and slow growth erode the American middle class and diminish U.S. global influence. So the question really is, which path will we take? The difference between these scenarios isn't predetermined, and there are no crystal balls allowing us to foresee the future. Fortunately, the good news is that the key to long-term investment success isn't forecasting the unknowable future. It's building portfolios robust enough to thrive regardless of what that future brings. You hedge against known risks. You diversify against the unknown. And the prudent investor does both. Over the last year and a half, most of our clients have seen us add infrastructure investments to their portfolios. Infrastructure benefits from both economic scenarios we've discussed. In the productivity renaissance scenario, demand surges for modern digital infrastructure, power grids, and transportation networks to support AI deployment and economic expansion. In contrast, in the fiscal stress scenario, governments prioritize essential infrastructure despite budget constraints. Roads, bridges, utilities, and broadband remain non-discretionary, regardless of the fiscal environment. Infrastructure also exhibits remarkably low correlation to traditional equity markets and has delivered attractive returns with bond-like stability, even during periods of market volatility. More recently, we've been adding reinsurance to our portfolios. These securities offer unique diversification benefits that fits both economic scenarios. Unlike equities and bonds, reinsurance returns are driven by natural catastrophe events, not economic cycles or monetary policy. This produces returns with near zero correlation to traditional markets. In fact, reinsurance performance tends to be uncorrelated with what happens in the economy. That means reinsurance can deliver gains precisely when markets struggle with inflation, recession, or both. This combination of uncorrelated returns and attractive yields makes reinsurance a great hedge. It doesn't require you to forecast the economy correctly, and it rewards you for risks that traditional investors neglect. If this is not in your portfolio yet, expect to see it being added soon. In summary, smart investors prepare for multiple scenarios rather than betting on a single outcome. Focus on building resilient, anti-fragile portfolios that can withstand economic shocks. The bottom line is this: we don't know which path the American economy will follow. And frankly, neither does anyone else. What we do know is this: economic uncertainty is not an invitation to sit in cash or retreat into fear. It's a call to build portfolios that can thrive across multiple futures. That's exactly what we've done with your accounts. We've positioned you to benefit from an AI-driven productivity boom while protecting you against fiscal stress and market volatility. We've added uncorrelated return sources like reinsurance. We've maintained the diversification disciplines that have served you through multiple market cycles. Our job isn't to predict the future. It's to make sure you're never blindsided by it. If you have questions about how these economic scenarios might affect your specific situation, your portfolio, or your financial plan, I encourage you to reach out. We're always here to walk through the details and make sure you feel confident in your strategy. And with that said, on behalf of all of us here at Prosperity Advisors, we wish you and your family a wonderful Thanksgiving and a prosperous holiday season ahead.